Hi, good morning everyone, and thank you so much for joining us here today. My name is Wei Ren. I'm a Senior Portfolio Manager at iFast, and I just wanted to start my sharing today by saying that 2026 hasn't really been an easy year for us investors. We've got a war in the Middle East, we've got oil prices going all the way up to 120, and the Strait of Hormuz was effectively closed for in the early parts of this year. But we've had a ceasefire, we've had oil prices then coming back down again, and just when you think that things have started to stabilize in the markets, we've had a sell-off in AI-related stocks. And then we have also have a renewed escalation in tensions between the US and Iran. So if you are sitting here today wondering if what you should be doing with your portfolios given the renewed uncertainties in the markets right now, you're here at the right place, because that's exactly what I'm going to address today. I'm going to address what's happening in the Middle East, number one. Okay, I'm also going to address the sell-off in AI-related stocks. And I'll also be telling you where the opportunities are in the markets right now. Okay, so how many of you have been to the petrol station recently and you tried to pump petrol, thinking that oil prices have come down, so I should be paying less for my petrol price? How many of you have realized that actually my petrol prices haven't been coming down as fast? The reason why this is happening is because the cost of refining your crude oil into petrols, into the various fuels that people actually use, it is still very high. Okay, it's a bit like buying a car. You can have the price of the car falling, but does that automatically mean that the cost of car ownership in Singapore has been lowered? No, it's not straightforward. It's not so straightforward because you also need to consider the cost of your COE prices. So you can have a case where car prices go down, but your COE prices go up. So does that mean that you, as an end consumer, who is paying for both the car price and the COE prices, does that mean the cost of car ownership for you is lower? It's not so straightforward. And it's the same for oil prices as well. So when you pump petrol, you don't actually pump crude oil into your petrol. The crude oil needs to be refined into the actual fuels that people use before you can put it into your car. And the cost of refining petrol into fuels right now is very high. This cost is also what is known as the crack spreads. Okay? And I want everyone to look at this particular chart on this slide right here. Okay? So the blue line represents oil prices. So oil prices have been falling, as you can see, very sharply to near pre-war levels. But look at that orange line, the crack spreads. The cost of refining crude oil to the fuels that you use, has it been falling? No, it hasn't. In fact, it has been going up, and it is currently at record highs since 2022. And I believe you may have already seen the chart already. And that's the reason why, even though oil prices have come down, inflation is far from over. I hate to tell people bad news on a Saturday morning. Okay, but I have to tell you this, inflation is not over, and the cost of refining crude oil into fuels is only one reason. The second reason is because there is a real risk that this ceasefire could eventually break down. The ceasefire deal that all of us have been reading about, it is actually just a memorandum of understanding. It is a deal to talk about another deal. So now they are talking about this final deal and they have a 60-day period to talk about it. But we're barely even at the halfway mark of the 60 days. Look at what's happening. There has been renewed escalations between the US and Iran. And last night, Donald Trump just announced that the ceasefire is over. There is now a real risk that this deal can break down. And when it does, guess what's going to happen to oil prices? It's going to go back up again. So that's the second risk we need to be aware of. Number three, food prices. Okay, this one has got nothing to do with oil prices at all. This one has got to do with your fertilizer prices. At the start of this year, when the Strait of Hormuz was closed, the supply of fertilizers was actually disrupted. And that caused the prices of fertilizers to skyrocket. So the farmers, they have already paid the high fertilizer prices during the planting season. So when they harvest the crops, they're going to price their produce according to their own cost of production. And what does that mean for consumers like you and I? We're going to get increased prices for the food that we buy. And it is also the reason why grocery costs has been rising well above headline inflation. not just in Singapore, but at the global level. Your memory prices, don't forget, memory prices have also skyrocketed. The chips that are going into your smartphones, the chips that are going into all the electronics that we buy, they're all getting more expensive. So much so that companies like Apple and other electronics manufacturers, they have no choice but they have to start raising their prices and pass the cost on to consumers like you and I. So when you put all these four factors together, you will start to see why lower oil prices, it doesn't automatically mean that inflation is over. And it's not just us saying this. Okay? Look at what some of the members of the Federal Reserve are saying. Cleveland Fed's Beth Hammock. She said that we've got inflation that's too high. And what this means is that we may need higher interest rates. Higher interest rates, not lower. So the implication of this is that inflation is currently not over. It is expected to be higher for longer, and it also means that rate hikes are coming. So the portfolio implication of this is you should stay away from the areas where they will likely come under pressure in the rising interest rate environment. And what are some of these areas? Number one, stay away from your long duration bonds. For fixed income, you just stick to short duration. Number two, you avoid the long duration, loss-making tech companies that are trading at insane multiples. Stay away from these because they are also going to come under pressure in a rising interest rate environment. And last but not least, avoid REITs. Okay? REITs also don't do well in a rising rate environment. I know some of you here, you really love REITs. Okay? And I can understand why. Because REITs give you a regular source of income. So you must be thinking, hey, what is Weiren saying? Stay away from REITs. Yes, now is really not a good time for you to buy REITs. Okay? If you want some ideas on what else to buy other than REITs, I've got a couple of other suggestions later in my presentation. Okay, but for now, suffice to say that REITs is probably not a good choice to be in for the second half of this year. So that was the Middle East. Okay, so right now, I also wanted to address something else that is perhaps on everyone's minds right now, and that is the AI sell-off. The most recent trigger for this sell-off was actually news reports of Meta building a new cloud business to sell its excess computing capacity to outside customers. So why is this so alarming? Meta has been spending lots of money to build its own AI infrastructure. So if a company like Meta suddenly says that they have excess capacity that they want to sell to outside customers, it could potentially mean that they have too much. They have overbuilt their data centers. They have an oversupply situation. And what that also means is that the industry as a whole could have an oversupply and that the AI trend could finally be over. But is that true? Now, to answer this question, what I want everyone to do now is to imagine yourselves in the shoes of Mark Zuckerberg. If you are the CEO of Meta and you wake up one day and you realize that your company has actually built too many data centers, what do? Maybe you'll slow down the construction of your data centers. Maybe you'll cancel a couple of contracts. And the one thing that you definitely would not do is to sign even more contracts for additional capacity. That is not what Meta is doing. Look at what they have been doing over the past few months. In March of this year, Meta signed a deal, a $27 billion deal with Nebius for additional data center capacity. In April, it signed another $21 billion deal with CoreWeave for additional capacity. And just a couple of weeks ago, in June, they signed yet another deal for more data center capacity. That's not the behavior of a company that is sitting on too much data center capacity. And there's also another development that I think is worth highlighting here, which is that in March this year, Google couldn't supply Meta with all the computing capacity that it wanted. Meta was in fact having a shortage, and the shortage was serious enough that Meta actually had to do its own internal rationing. So think about this. This is a company that has been actively signing deals for more data center capacity. And this is also a company that is not getting enough computing power from Meta as early as March this year. So my question to everyone is there an oversupply situation? Does this look like a company that is sitting on too much capacity? Doesn't look like it. And let's assume that we are wrong. Okay? Let's assume that Meta really does have too much data capacity. But even then, what's happening at one company is also not an accurate reflection of the entire industry. Just look at Google. Google's cloud backlog nearly doubled in the first quarter alone. And this is what their own CEO said. We are compute constrained in the near term. Our cloud revenue would have been higher if we were able to meet the demand. They don't have enough capacity to meet its own cloud demand. And in fact, Google is renting capacity from SpaceX because its own data centers just can't keep up with demand. And don't forget, Google is also a hyperscaler. It has built its own AI data center infrastructure, and it also has one of the largest budgets in the industry. And even then, it is still not enough. Google has to go out and rent additional data center capacity. So that's a shortage. Look at Korea's export numbers. Semiconductor exports rose almost 200% year-on-year in June. And look at what's happening to prices. TSMC is rolling out 5 to 10% price increases. Samsung and SK Hynix, memory prices up 60 to 90% quarter-on-quarter. And what this tells you is that supply still can't keep up with demand. And these companies have a lot of pricing power. Why? Because their customers have nowhere else to go. The shortage is across the entire industry. You can't just say, oh, I don't want to buy chips from Samsung and SK Hynix. I go to somewhere else. You go to Micron, they are also having a shortage. So in this market, it's either you queue up or you don't get your chips at all. That's the kind of power they have for all these manufacturers in Asia. And Micron's earnings result blew past expectations. And this is what their chief business officer said. We don't really see when supply is going to be able to meet demand. So you've got export data up, backlogs are up, the prices are up, and the company that is manufacturing memory chips, they can't even tell you when all this is going to end. And look at what other supply leaders in the industry are saying. Jensen Huang, the single most important person in the AI industry, what did he say? He said that the shortage will persist for several years. Not weeks, not months, years. Tim Cook, he has described this shortage as a 100-year flood, and that he has never seen anything like this in 40 years. And Apple is actually not a chip designer. It is also not a supplier that is benefiting from this shortage. Apple is actually a buyer of semiconductor chips. So it is actually suffering from this shortage right now because they are the ones who actually pay the higher memory prices. So Apple has zero incentive to want to hype up AI demand. Apple has zero incentive to tell a story that will lead memory prices to go even higher because it hurts their own margins. But even Apple is saying that this shortage is real. CEO of ASML. So this is a company that manufactures machines that make the semiconductor chips. So they see demand before anyone else in the industry. And he's saying that ASML's customers have confirmed they are sold out for the rest of the year. Now, 3 of the most important people in the industry, they're all telling you the same thing. And these 3 companies, they sit in different parts of the supply chain. We've got a chip designer, we've got a company that is manufacturing the equipment to do semiconductor manufacturing, and we have also got one customer who is the one that is actually buying the semiconductor chips. And this is also why we continue to recommend Asia Semiconductors. So back to the question, is the AI trade over? The answer to that is no, we don't think it's over. But what you buy to get exposure to AI trade, it matters. So if you want something to get exposure to this trade, our recommendation is Asia Semiconductors. This was our exact same recommendation, Asia Semiconductors. So if you have bought it and you're thinking whether you still can buy more, yes. If you have missed out on this rally altogether and you're thinking, oh, is it too late to get in? No, you can continue to buy Asia Semiconductors. Okay? We love Asia semiconductors. Valuations is one reason. When you're trying to find opportunities in a market that is crowded, in a market that's near record highs, valuations is one of the most important things that you need to look at. And when you compare the valuations of Asia versus the US, I think the picture is very clear. Asia semiconductors are currently trading at a PE ratio of 40 times. US semiconductors, 28 times. Of course, some of you will say, you get what you pay for. In Chinese, we say, 一分钱一分货. You pay peanuts, you get one piece. So you're not paying less because the growth is slower. You are paying half the price or even better growth. And this is why our recommended product remains the Global X Asia Semiconductor ETF. We must remember that Asia is the manufacturing backbone of the global semiconductor industry. NVIDIA can sell all the chips that they want, but somebody has to manufacture all these chips for them. Where are all these manufacturers? In Korea, in Taiwan, in Japan, in China, all in Asia. Every single dollar of AI spending at the global level is going to flow through your Asia supply chain. And that is why we continue to buy Asia semiconductors, and we recommend this we continue to recommend this ETF to our investors. So our target price for this ETF is 334, and based on this last closing price, we're looking at a potential upside of 74%. So can you buy? Yes, you can buy. So after my show today, in the next few weeks, you can potentially see some volatility in the markets. Semiconductor stocks may continue to sell off. But as I've shared with you in my previous slides, the shortage is real, the shortage looks durable, and fundamentals have not changed. So if it's cheaper, that's actually your signal to buy even more Asia semiconductors in your portfolio. So that was Asia semiconductors. And the one interesting thing that I realized also is that this valuation gap between the US and Asia is not just limited to the semiconductor industry. In fact, this valuation gap shows up across the entire Asia region. 33.3% in 2026, 18.8% in 2027. For the US, 26.4%, 14.9% respectively. So Asia's earnings are not just comparable. Asia is growing faster, but at a 40% discount.
And this is why we are positive on Asia. So if you can recall, at the start of this year, when the conflict first happened, what did people say about Asia? Sell Asia. Why? Because Asia imports a lot of its energy needs. So if oil prices go up, Asia's growth is going to slow down. That's why you should sell Asia. But look at what happened to Asia GDP growth in the first quarter. Taiwan, GDP up 14.6. Singapore up 6%. China up 5. Japan up 2.1. So Asia was supposed to suffer, but it didn't. It was very resilient. It delivered this kind of growth in the middle of a war when the Strait of Hormuz was closed. And this is exactly why if the Middle East, if there is going to be a further escalation in tensions again, if oil prices go back up again, Asia has already proven that it can still do well. That's the reason why we are positive on Asia. It's cheap, it's got solid earnings growth, and all of this is independent of whatever that is happening in the Middle East. So which parts of Asia should you focus on? One of the ways to get exposure to Asia is to simply buy your broad-based Asia ex-Japan equity funds, and I've got some recommendations here for you right here on this slide. Alternatively, you can also invest in specific Asian markets. So I've talked about Asia semiconductors, which includes Korea and also Taiwan. But if you want something that is maybe underappreciated by the markets right now, I've actually got a couple of other suggestions. Singapore, our home market. That's a market that we like. Why do we like it? Now, let's start with the macroeconomic data. Singapore's exports in May grew 38.4% year on year. So that's actually the fastest pace since February 2012. And within that, our electronics exports alone were up 94.8% year on year. And this isn't just one single good month. Okay? This has been a consistent set of performance on a year-to-date basis, which is why our exports on a year-to-date basis, it is up 18.1%. So This is because of AI. Singapore is part of the global semiconductor supply chain, and our economy has benefited directly from this boom in AI demand at a global level. NVIDIA has also chosen Singapore as its regional AI research hub. When the world's most important AI company decides to put its research operations in our market, in our country, it is a vote of confidence. A vote of confidence in our workforce, confidence in our infrastructure, confidence in our regulatory environment. And that benefits Singapore directly. Number two, flows from the Middle East. Singapore is going to be a beneficiary of the capital inflows from the Middle East. The Gulf countries like Saudi Arabia and the UAE, all these years they have benefited because of their image as a stable wealth hub. But that reputation is now gone. It is damaged because of the conflict in the Middle East. So the super rich in the Middle East, they are now looking to leave. And when they leave, their wealth will also follow. And where does the wealth go to? One of the places that they would definitely consider is Singapore. Because we have political stability, we have the rule of law here, our currency is pretty strong, and we also have a sophisticated financial infrastructure. So we're going to benefit from that. The banks have already taken action. DBS is making its largest ever wealth expansion in the Middle East. MAS has also taken action. MAS is now cutting the time required to open private banking accounts down to 1 month in order to make Singapore more competitive in the eyes of the wealthy investors. So this is a trend that Singapore will benefit from. And last but not least, we've got policy tailwinds. EQDP, it is still one of the policies that will benefit Singapore. And we've also got the SGX NASDAQ Global Listing Board, which is expected to raise the prominence of our SGX companies to a wider pool of international investors. And this is a real structural catalyst for our stock market, especially for the small to mid-cap sector. So if you like exposure to Singapore's equity market, most of us here, we usually think of the Straits Times Index. That's also something you can invest in. But if you're looking for something that is outside of the Straits Times Index, you can consider the IFAS Amova Singapore Equity Fund. So this fund over here, it has substantial exposure to the small and mid-cap sector. And these are exactly the ones that will stand to benefit from some of the structural trends that I've just talked about. And on top of that, this fund is also one of the top performing Singapore equity funds out there. Okay, disclaimer, this is one of our own funds. So you may think that, hey, your self-praise is no praise. Okay, so don't take my word for it. Okay, after my sharing, go and have a look at the performance of this fund and see for yourself whether this fund is really one of the top performing Singapore equity funds out there. Now, the second market that I would like to recommend, China. Okay, so China hasn't been doing well this year. Okay, it's actually one of the worst performing markets. And one of the chief reasons for that is because the tech sector has been dragging down the performance of Chinese equities. Now, when I say China tech, most people think of China tech as one single trade. They typically think of Hang Seng Tech, which consists of your internet platform companies like Tencent, Alibaba, and Meituan. So this index is down by close to about 20% on a year-to-date basis. So if you just look at this single index, if you just look at the performance of Hang Seng Tech, you'll conclude that China tech has underperformed this year, that China tech is a broken story in 2026. No, that's actually not the full picture. Because China tech is actually two very different stories that is playing out right now. And they are moving in completely opposite direction. So Hang Seng Tech is one of them. Okay, Hang Seng Tech hasn't been doing well. It is down on a year-to-date basis. The other group of companies, there are the AI hardware makers that are supplying to the global AI industry. This group of companies, they are doing exceptionally well. The CSI All-Share IT Index, which is the benchmark for most of the A-share companies that supply hardware to the global AI industry, this group of companies, they have been doing exceptionally well. Okay? So there are actually two ways to play China's tech industry right now. Okay? And I'd like to start with the first one. So the first one is Hang Seng Tech. Okay? Don't look at this year's performance. Don't look at the 17 to 18%. What you really need to look at is the fundamentals of the companies that are inside this index. Okay? Look at Tencent, for example. Okay, Tencent is facing a bit of a pressure for real reasons, because China's economy, it is facing some challenges right now. Consumption is slowing down, competition is picking up, and investors are also concerned by the heavy spending on AI infrastructure. But look at Tencent's core business. Its core business margin, excluding its new AI investment, has actually expanded. And that's before you even consider the AI-driven advertising revenue, which is up 20% year on year. So it's doing fairly well. And guess what? Tencent is currently trading at a near record low PE ratio, as you can see from this chart right here. Tencent is the cheapest it has ever been since its listing on a Hong Kong Stock Exchange. Do you think this is fair for a company like Tencent, whose underlying business is actually doing pretty well? I don't think it's fair. I think it's attractively priced right now. Same thing for Alibaba. Alibaba Cloud's AI-specific revenue has grown 10 times in just 6 months. Management themselves, they are guiding that this could triple to 30 billion yuan by December this year, reaching 50% of their entire cloud revenue. So this is a company that is now starting to monetize its AI investment, and it's going to contribute significantly to earnings. So Hang Seng Tech is not broken. Okay? Buy Hang Seng Tech. Okay? This is a recovery story that is offering you deep value right now. So as we approach the second half of this year, once these companies start to report their earnings, and once the recovery becomes visible in their earnings numbers, that is when investors will start to take notice. That is when the share prices of all these Hang Seng Tech companies will rally in order to reflect the true value of these companies. So I think that's pretty underrated by the markets right now. It's underappreciated. If you want something that is underappreciated, Hang Seng Tech is definitely one thing to consider. And our ETF, our recommended ETF is the iShares Hang Seng Tech ETF. And if you want to prefer something that's listed on the SGX, we also have a similar Hang Seng Tech ETF that is offered by Lion Global. And this one is available for SRS investments. So that's the first trade, Hang Seng Tech. The second trade that you should take note of for China is the AI hardware makers that have been doing well this year. So when it comes to AI, everyone talks about the US. But what I think is less appreciated is the fact that China is also in the midst of its own AI boom. Hyperscalers like Tencent, Alibaba, ByteDance, all of them are ramping up their AI spending. And a large part of that spending actually goes to the Chinese companies that are building the hardware that powers the AI infrastructure. So look at the CSI All-Share IT Index. So that's the benchmark for all these A-share companies that produce the IT hardware. So all 158 constituents within this index posted a 74% net profit growth in the first quarter. 74% across the entire index. So this is not just a case where one or two companies, they do exceptionally well, while the rest, they are not. This is a case of the entire industry that is doing well. And part of this is because of the US export ban on semiconductors. So the US has restricted the sale of its most advanced semiconductor chips to China. So China has no choice but to turn to domestic alternatives instead. And that is why your domestic chip designers like Hygon, Cambricon, all these companies have been doing so well. Cambricon's first quarter revenue was up 160% year on year. Now, some of you may be thinking, this looks like a domestic story. Chinese companies manufacturing for Chinese companies. It is not. It is not. China is also benefiting from the global AI demand. And let me show you what I mean. Take Foxconn as an example. Its profits grew 102% year on year in the first quarter. So Foxconn is actually the world's largest manufacturer of AI servers. It is also NVIDIA's largest manufacturer of AI servers as well. So Foxconn is getting orders not just from its own Chinese customers. It is getting orders from international customers as well. And that is the reason why it has been doing so well in terms of its profit for the first quarter. And China also dominates the production of your printed circuits boards, which is a key part of the global AI supply chain. Nearly all of the circuit boards that goes into the hardware of NVIDIA, Apple and Google, all of these circuit boards are sourced from China. So China is a key part of the global AI supply chain. And this is also showing up at the national level data. China's semiconductor exports are up 111% year on year in May. So yes, China's economy may be facing some headwinds right now because of the real estate sector, consumption may be slowing, but this is a bright spot within China's economy. Its hardware players are benefiting big time because of the domestic demand for AI infrastructure as well as the global demand for AI infrastructure. So if you're looking for the next AI trade, it's probably in China. And if you would like to get exposure to this trade, I've got two product recommendations. So the first one is the ETF that gives you exposure to the CSI All Share IT ETF. So this one is from Guangfa, and this is the ETF that is listed on the mainland stock exchange. The other option that you can consider, if you want something that is a bit more actively managed, it is the China Evolution Equity Fund by T. Rowe Price. Okay, so for China, we've got two trades that we recommend for you to play the tech story. And I've been spending quite a bit of time talking about Asia. So right now, I just wanted to spend a bit of time to talk about the US as well, because it is the largest market in the world. And I suppose a lot of us, we have US exposure inside our portfolios. So we're underweight the US. And I want to be very clear about what this means. Okay? We're not saying that US companies are bad. Okay? In fact, their earnings are pretty good. This has been one of the best earnings seasons in years, and a lot of the companies, they have beaten their earnings expectations. So the earnings is there. What we do not like about US, valuations. It is not cheap. S&P 500 trading at 22.3 times PE ratio. That's actually above our fair value estimate of 20 times. So this is a market that is pricing in quite a fair bit of optimism. And some of that optimism has turned into greed. Look at SpaceX. People are willing to pay insane prices just to get into SpaceX. At its peak, SpaceX was trading at a market cap that was bigger than Amazon. All of us know Amazon and how big this company is. SpaceX was bigger than that. It's also trading at a multiple that is 4 times higher than NVIDIA. And this is a company that has no earnings. It's a loss-making company. Its business model is based on a technology that is unproven. But still, investors want in on SpaceX, and they are willing to pay insane prices. So what does this mean? It means that the same kind of risk-taking behavior, the same kind of greed, it is probably inflating the valuations of other parts of the US equity market as well. So this is a market that is pricing in quite a bit of optimism. So at the index level, we are underweight the US. So the key for US market is to be selective and focus on where valuations are still attractive. So what's still attractive? Your internet companies, still very attractive. Your big tech companies like Microsoft and Amazon, all of these are attractively priced. These companies used to be popular companies when you think of US tech. Or the first company that you want to invest in, Microsoft, Alphabet. Everyone wants to own these companies. But this year, nobody wants to own them. Okay? It has underperformed the market. All these tech companies that used to be popular amongst investors, they have been left out of this AI rally entirely because investors are worried about the massive spending on AI infrastructure, and they are worried that this may not deliver the kind of returns that they are looking for. But look at their fundamentals. Both companies, Microsoft, Alphabet, they just posted some of the strongest cloud growth and AI demand they have ever reported. Their backlogs are growing even faster than their revenue. So their share prices are down, but their earnings are up. And growth doesn't look like it's going to slow down anytime soon. So underweight the US, but don't ignore the market entirely because we think there are real opportunities out there, and we think internet companies is currently very attractively priced at this point. So if you haven't been buying the big tech companies, now is the time to consider buying in because we think the fundamentals are there, valuations are attractive. Okay? So if you want an ETF instead of a single stock recommendation, then our recommendation is the Invesco Nasdaq Internet ETF. And within the internet space, we also have a recommendation for cybersecurity. So if you're looking for more niche exposures within the tech sector, you can also consider the Global X Cybersecurity ETF. Okay, so this is my last slide, and I just wanted to conclude with 3 things that you should take away from today's presentation. So I talked about how inflation is going to stay higher for longer and how rate hikes are likely going to be the base case as we move into the second half of this year. And what that means for everyone is you need to reduce the rate sensitivity of your portfolio. You need to stay away from the areas that are likely under pressure in a rising interest rate environment. So avoid long duration bonds, avoid loss-making stocks that trade at high multiples, avoid REITs. Fixed income, if you have fixed income exposure, rotate into short duration bonds. Number two, for your equity exposure, stay overweight Asia. We love Asia. I think I have talked a bit about Asia this year, so you know why we love Asia. So stay overweight Asia, and if you want to know what are some of these exact opportunities, I've talked about 3 of them. Semiconductors, Asia semiconductors, very specifically. I've talked about Singapore. I've also talked about China. And for China, I talked about 2 trades. One is your Hang Seng Tech. The other is the AI hardware makers that are benefiting from the global AI demand. And last but not least, if you're worried about volatility, if the Kospi index falling 10% in a single day is something that you are very worried about, then I will recommend that you slowly build your exposure to Asia semiconductors using regular savings plan. Okay? And with that, I've come to the end of my presentation. Thank you so much for your time.